So we do have on today, obviously we've got the standard jobless claims. We have a Canadian trade balance, but we do have services PMI coming out today, as well as factory orders. Some good moves here. ISM non-manufacturing also due out, and Canadian IV PMI. Be one moment. Yeah, I don't know why. Okay, because Blake was saying some people couldn't hear, but I hit the broadcast button, so I'm not sure what was happening. Actually, the webinar starts at 5:45 Central Standard Time, 6:45 Eastern, and I hit the start broadcasting at 4 minutes before it started. So I'm not sure. Some people were saying that they couldn't hear, but yeah, I hit it earlier. Actually, at the time I had the mic on, even mute, but I'd already hit it. So I usually wait till 1 minute before the broadcast starts. This time I hit it like about 4 minutes before, so I'm not sure where the problem would have been. But anyway, going into tomorrow, we'll obviously have a Eurozone employment. We have U.S. non-farm payroll employment. But for today, like I said, we do have some movers in here. Obviously, the standard jobless claims, trade balance, factory orders, durable goods, and IV PMI also. Let's go and move into the news. Okay, the Canadian dollar hits an 18-month low as investors slash rate hike bets. One of the things I was talking about, I don't know if some of y'all couldn't hear me. I'm not sure why, because I hit the start broadcast button about almost 4 minutes before the webinar starts. Usually I wait till a minute. But one of the things I pointed out was on the dollar CAD, and that we discussed that yesterday, was that 33.80 I thought was a good area, but the key thing is that on the daily, and we're looking at a daily chart here, you see we had taken out 33.42, taken out that 33.42. That's the highest close up to that point right there, 33, maybe it's 44. So that opened the door for us to go to the next area, and that was 34. Actually, it's here on the levels 34.09, but 34.12 is a 78%. Trying to work, we're actually coming off a little bit. We got up as high as you can see. This level right there comes in right there. 34.49. We made up to, what was it, 46 or 44. So maybe now we'll start to see things come up. But one of the reasons that it actually worked against the dollar CAD was this further fall in crude oil. And the reason we got the further fall in crude oil is because of the concerns of global growth, which obviously we knocked this S&P down lower. And as I was saying earlier, I don't know if some people couldn't hear me. Is that, we saw this big old, basically it's a flash crash that many people were saying about that, because they said it couldn't, CME said it could have been worse. And me and Joe were talking about it in the Asian session, and we were trading around 26.80. And I said, hey, look, you don't fall this far, this fast without them having to go back and actually probably go down here and test these lows. And sure enough, here we are, nearly 30 handles from where him and I were talking about. About 24 handles from where him and I were talking about in the Asian session, lower. So we had gotten up to around 82-ish or so, maybe even a little bit higher. It looks like they made up as high as 83. So when him and I were talking, I think it was like around 81 or 82. And here we are pressing lower. And one of the things we talked about, so in case anybody missed it, was here on that, we had referenced that story from before about the yield curve and the inversion. And we were talking about the importance of the 5-year. This is almost 2 weeks ago, and I shared that story. Joe and I were talking about that also. And so you can see how now with this run up in bond future prices, obviously a correspondingly run down in interest rates, that interest rate differential that's been playing to the dollar's benefit is now going to start to erode. Now, obviously, we're moving higher in bunds. Look at that. So you can say, well, it's tit for tat, but don't forget, it's the U.S. that has gone way beyond and not only has seen those differentials, they've even flipped the script with other currencies like, the Aussie dollar. So it may take some time, but I think, like I said, somewhere along the line, you'll see the dollar impacted. It's the same way that eventually S&Ps, took their hit overall, and now we're seeing that on any little bit of news. Now we're very susceptible to falling, and I think that eventually that may end up coming and working against the dollar. So hopefully that catches up to where we are now. Let's take a look at the news. Canadian dollar hits an 18-month low as investors slash rate hike bets. Hang on, I'm gonna get just a quick drink. One of the things we were talking about, once again, I was talking to one of the gentlemen yesterday in the Asian session who had been short dollar CAD and wanted to add. And I said, hey, look, you ought to wait till things start to turn around where the market can't go higher, that you start to lose the momentum instead of just trying to fade it. Because like I said, we learn the most from our mistakes. And I tell you what, I've made so many mistakes trying to fade runs. I think finally, hopefully I've gotten that out of my system. And I just recognize, hey, look, if the momentum's going one way, don't stop it or wait until the momentum starts to turn, unless you get like a little peak area here. Now, like right now, we're looking, well, this is actually on a 30-minute, but have a little bit of a mini gravestone doji. We'll kind of take a look at it on a 2-hour, but let's go on and change that and get to the news here. So it says the Canadian dollar weakened to a 1.5-year low against the greenback on Wednesday as investors slashed expectations for further interest rate hikes from the Bank of Canada after a dovish announcement from the central bank. The Bank of Canada kept its benchmark interest rate on hold at 1.75% as expected and said there might be more room for non-inflationary growth, suggesting the pace of future hikes could be more gradual. I'm not sure why people thought it was going to be bearish. To me, it didn't make any sense. Why would you back yourself in a corner, especially in light of everything's going on with China and the U.S.? I mean, that's what I'm saying. I'm not sure why people thought that it might come out, hawkish or it might be whatever. At the least, it could have come out maybe neutral, but now they're saying it came out dovish. But why would the Bank of Canada box themselves into an interest rate hike? I didn't really get that. Or maybe they didn't expect it, but maybe they expected more of maybe not hawkish, but more of a stronger tone. And I don't see, maybe dovish tone probably did throw the market off, but I don't think there would have been any reason for them to suggest any type of rate hikes in the future in light of the way the overall risk is in the global economy between U.S. and China. Anyway, from that being said, from where we were the last time out, things are a little bit more dovish in tone, and not surprisingly, we've seen the Canadian dollar weaken. In the wake of that, said Michael Gregory, chances of a hike in January slumped up from about 60% from the data to 35%. The overnight index swaps market indicated. The loonie weakened as global stocks were pressured by renewed worries about trade tensions and as the U.S. dollar strengthened against a basket of major currencies. The price of oil, one of Canada's major exports, weakened ahead of a meeting of the world's biggest exporters, which will discuss cutting the output to help shore up prices and curb excess supply. Now, that I would have thought what was going to help the Canadian currency. But don't forget, as I said, this whole China news story about the arrests and all that, well, the glass is people are already looking at the glass half empty. So when the S&Ps got whacked, once again, we had that concern for global growth, and obviously that took the oil down with it and certainly impacted the negative, the dollar CAD, certainly pushing it to this upside. That being said, Alberta's decision to mandate output cuts to reduce a glut will hurt North American producers of lighter oil used for blending and U.S. refiners importing crude via rail, even as 7 major Canadian energy companies cheered the move. The Canadian government's bond prices rose across the curve with the 2-year yield up to 2.05, up 12.5 to 2.05. And on to Australia, New Zealand dollars, trampled in risk rout and bonds boom. We've been talking about that. As I said, we had that story 2 weeks ago about the 5 years, and we had seen the greatest move that they had recorded in that flip, and that kind of ended up leading us to where now we are now with interest rates just jumping all over the place. And actually, we've now seen a yield inversion with the 5-year. But it says the Australian and New Zealand dollar slipped for a third straight session on Thursday as fears of a renewed Sino-US trade tension spooked stock markets while investors toyed with the idea of a possible rate cuts at home. Shares slid after Canadian authorities arrested a top executive of Chinese tech giant Huawei with extradition to the United States, straining ties between the two superpowers. The Aussie dollar dropped to 72.24, wiping out a week's worth of gains and taking it further from the recent 73.94 top. Australia's 2-year bond yields dived to their lowest in 9 months at 1.93 as futures priced out the prospect of a rate hike and replaced it with a minor chance of any easing. The sea change started after the data on Australian economic growth out on Wednesday proved surprisingly soft, with wages and consumption notably subdued. Remember, the data when it comes to employment out of Australia for the last 4 months or so has been pretty strong. So this was a bit of a surprise there. That was followed overnight by a dovish turn from the Bank of Canada, which noted there may be additional room for non-inflationary growth. Marks responded by sharply paring back expectations of further hikes there and punishing the Canadian dollar, causing collateral damage to the Aussie. Thursday's helping of domestic data did nothing to alter the mood, with retail sales up a modest 0.3% and trade surplus missing forecasts. The run of news led Nomura economist Andrew Treichert to abandon forecasts for rate rises by the RBA. We now expect a flat cash rate profile continue for an extended period, he said. We suspect the market could come to price in a small possibility of a rate cut. While this goes further than our thinking, we do understand such sentiment and believe this could result in some yield curve steepening pressure. Yields on the New Zealand government bonds fell to 2.478%, the lowest since May of 2016, and down a huge 40 basis points in just the past month. While the New Zealand economy has performed reasonably well in the past few months, the RBNZ has remained resolutely dovish on policy, leaving the market pricing in a small chance for an easing next year. The stubbornly dovish bias is understandable given inflation has been too low for too long, said Kiwi Bank economist Jared Kerr. It will take a lot to get the RBNZ to get RBNZ rate hikes. Rates are unlikely to head higher in 2019, and hikes are a 2020 story at the earliest. And sterling's fate hangs on Brexit and the UK growth to weak. Sterling's near-term fate hangs on whether British Prime Minister Theresa May manages to get her Brexit withdrawal deal through Parliament. According to Reuters polls that are also found the economic growth will be weak. May faces deep opposition in Parliament ahead of a December 11 vote on her withdrawal agreement, raising the risk of a no-deal Brexit shock to the economy in less than 4 months' time. She suffered embarrassing defeats on Tuesday at the start of the 5 days of debate over her deal to leave the European Union that could determine the future of Brexit and the fate of her government. Our colleagues are right to flag the risk, and the Parliament could initially reject the deal. This inevitably leads to a knee-jerk sell-off in sterling. We think there is likely to be a material repricing of the UK rates once the deal is announced and ratified, which in turn is likely to be bullish for sterling. Sterling has ricocheted on each piece of Brexit news, largely ignoring economic data as predicted in the Reuters polls. There's still only a median chance of 25% probability no agreement is reached before Britain is due to leave the EU on March 29th, unchanged for the November poll. Instead, almost 90% of economists who answer an additional question expect the most likely outcome to be the two sides agreeing in a free trade deal. Still in second place was leaving without an agreement and trading under the basic World Trade Organization rules. And once more in third place was Britain being a member of the European Union. While the second and third outcomes were a close call, Brexit being canceled was seen as unlikely, and no respondent pegged this as the most likely scenario. With little clarity about the terms in which Britain and the EU will part ways, Britain's service firms were clobbered last month, leaving the economy at the risk of contracting. And we've already covered some news. Remember how they're really, not in large numbers, but significant numbers in the financial industry. They're really starting to move a lot of stuff offshore now, and have been actually for over a year. And that's certainly going to go on weigh on this, and maybe in a longer term basis will certainly weigh on sterling. Moving on to the dollar, lifted as Huawei CFO arrest triggers trade concerns. The U.S. dollar and yen gained on Thursday after the arrest in Canada of a top executive of a Chinese tech firm prompted fears of a flare-up in U.S.-China trade tensions. The dollar has been under pressure recently over concern about a possible U.S. recession and an inversion in part of the Treasury yield curve. But the arrest of Huawei's technology chief financial officer lifted safe haven demand for the dollar as doubts emerged over the truce of a trade struck days ago between President Trump and Xi Jinping. The arrest is related to violations of U.S. sanctions, a person familiar with the matter said. Political quarrels outside the trade arena could jeopardize the success of the trade talks. This is causing risk aversion to rise again. An aversion to riskier assets set in, and that benefited the Japanese yen, a safe haven currency, and pressured the Chinese yuan. Against a basket of 6 rivals, the dollar index was edging up at 0.2 to 97.20. Of course, we're just a little bit above 97 right now. The dollar fell broadly earlier this week after a thawing tension between Washington and Beijing. It's also been pressured by worrisome signs in the U.S. bond market about economic growth and signals from the Federal Reserve that a slowdown in the pace of interest rates may be coming. The dollar could remain under pressure this month. The Fed's meeting, when the market will see the Fed's stance on policy and the economy, said Junichi Ishikawa. The recent reaction in the U.S. yield curve inversion appears to be a little hysterical. But the dollar will not give the all-clear sign until the Fed meeting is hurdled. Fed policymakers are still widely expected to raise interest rates again. They're saying this is a little hysterical. This is kind of laughable. And the reason is because you could have said the same thing. And all this stuff means nothing. Look at this. Wasn't that hysterical? I guess not. But this move is now hysterical. But look at this move. And this move is almost, twice as much. But only this move is hysterical. That's what I'm saying is once interest rates get going, they get going like this, it's hard to stop that train. And that's why we kept, when we focused and we covered about the 5 years, that story from Brian McGeevan, we covered it here. I even posted on Twitter, and it didn't garner much attention at all. And I was a little bit surprised. And the 5 years had made such a material change. It was the biggest change in the flip of being short to, reversing those positions ever recorded. And it didn't gain much attention. I was talking to that about Joe last night. And then all of a sudden, then we get this big move followed by that. And then we actually get a yield inversion with the 5 year. So it's kind of funny that now this is hysterical when that big move lower when interest rate took off wasn't hysterical. It's going on to the German Bund yield, near 6-month lows as stocks take a beating. The yields on top-rated German government bonds held near 6-month lows on Thursday after the arrest of a top executive. Italy's bond market, usually vulnerable to a sell-off in other risk assets, held its ground thanks to signs that Rome is likely to change its controversial 2019 budget. Across the single currency block, the 10-year yields, bond yields were 1 to 2 basis points lower in early trade. Bund yields are not far off the lows at the peak of a rout in Italian-bound markets in late May, reflecting the uncertainty in world markets regarding trade tensions, the growth outlook, and next week's key vote in British Parliament. We're approaching the year end, and no one wants to take on risk. The sell-off followed news that the daughter of Chinese tech giant has been arrested in Canada and is facing extradition to the U.S., dealing a blow to hopes of an easing U.S. trade tensions. Uncertainty ahead of a meeting of the OPEC on Thursday also supported demand for bonds. The meeting expected to result in a supply cut aimed to drain a glut that has pulled down crude by 30% since October. And like I said, I thought at the beginning of this week, I mentioned it on Thursday when they were talking about that meeting we're referencing the dollar CAD. I thought this would be supportive, and it was initially. But like I said, with that arrest, the market was already down, and concerns about the global economy, that just dragged this crude down here to test this area and certainly opened the door for the dollar CAD, which has already moved higher, to push even further and go, which it actually did go beyond even the next target, which was 34.12. Italy's government will make a final assessment on Thursday of the cost of the main measures contained in its 2019 budget. Matteo Salvini said. Italy announced on Wednesday it could carry out a syndicated exchange transaction where the Italian treasury will be buying back some short-dated Italian and tap a 3-year bond maturing in 2021. And let's go on. This is one of the more important things. One part of the U.S. yield curve just inverted. What does that mean? Spend a little bit more time on this because I think it does make. That's why this market is moving like that, and why I said once again I was talking with Joe is you don't make these kind of moves like this when there's not something. If this was just a one-off news story or a news story's been hanging on, you get a pullback and the market goes back or maybe test. You see a waterfall like that, it's because the market was already in that type of a mode. Not only were we concerned about the things with China, but the run in interest rates, and go back to the same thing I mentioned earlier. It's the old story. The bond guys are the smartest guys in the room. And they always, and they're the ones, and we saw this with the 5-year story 10 days ago, and look, here we are now. Here we are taking off in the 30-year, and we've got these worries now, and it's opened the door for S&Ps to just slam down like that. Part of the U.S. Treasury yield curve inverted this week, setting off a debate over whether it's delivering a classic sign of an oncoming recession or has just developed a short-term kink that can be explained away by technical reasons. Whatever the reasons, investors and economists ignored this message from the bond market at their peril. Yield curve conversions, when short-dated securities yield more higher than longer maturities, have preceded every U.S. recession in recent memory by anywhere from 15 months to around 2 years. The yield curve has sent a chill down investors' spines in regard to the future outlook of the U.S. economy, said Chad Morgenlander. To be sure, the week's inversion is limited so far to the front end of the curve rather than the more closely studied recession harbingers such as the gap between 2 and 10 years. Still in December 2005, for instance, a comparable inversion at the front of the curve was followed shortly afterward by an inversion between the 2 and the 10-year. The pattern was also evident in late 88 in advance of the 1990 recession, ahead of the 2001 recession. In the current instance, investors and economists are debating whether this economic weakness ahead reflects the factors of a reversal of the large speculative bets of declining bond prices and the Federal Reserve's large holding of treasuries. Central focus of whether it means the market is second-guessing the Fed, which has been raising rates for 3 years and expected to lift them further. Jeffrey Gundlach, Chief Director, Executive Officer of DoubleLine, and a closely watched bond investor, comes down the side of being a fundamental signal. It reflects a total bond market disbelief in the Federal Reserve plan to raise rates in 2019, he told Reuters. At the same time, this week's moves coincide with an ongoing positioning shift in the Treasury market. Once again, we posted this story over 10 days ago. I shared it with Joe last night about this gigantic shift in the 5 years. I posted it on Twitter. But the only person who responded was Anthony Crudele, and it didn't get a bit of attention. And all of a sudden, here we are days later, and the market just started taking off like gangbusters. But we saw the short positions in 5 years roll off and come off the books to the greatest in record, and nobody paid any attention to it. Hedge funds and other speculators amassed a record level of bets on declines in Treasury prices through the futures markets, with the heaviest bets lodged against 5-year maturities. But they've slashed that by more than half in the last few weeks and may have combined to the outsized rally in 5-year note prices. In particular, bond prices and yields move in opposite directions. A lot of its momentum, said John Canavan, market strategist with Stone & McCarthy. Record expansion. These potentials asides, the U.S. economy is in the middle of its second largest expansion on record, and economists and investors are mindful that a downturn is inevitable. Some business sectors like auto and housing are flagging due to partly rising interest rates, while debt-laden companies have raised concerns where they could keep up with their old debt payments. Some traders said the dramatic curve flattening may be overdone and may revert if the government's November payrolls report on Friday were to show solid jobs and wage growth. Let's just go on and move on to the bias chart now. I think we spent enough time there. But I thought it was important to give a lay of the land of where these markets are standing right now. So let's go move in now with the euro. Well, this 1320 held, but this area here, just so it looked like the euro could take off, really stumbled right in here and just wasn't able to get anything going. And depending on how this whole news story is going to play out, we've stayed in a relatively tight range. We really have. We have tested the 09 area. This 1313 area here. And for now, it would work as a trigger. We're just going to put this right here, and that would work as a trigger, which is 09. Although I think we're okay for right now. I think you got to let this thing play out. I'm not sure we're going to have a real good move until we get past non-farm payroll. So for right now, we're just going to go with this 1309, just move it a little bit lower because they have tested that area. On the upside, I still think it's important, this 1396. I think this market isn't going anywhere until tomorrow. If you're looking on a short-term basis, it'd be 1372. But I'm not so sure we're going to move a lot. And if we come up here, probably have some people lay off. I think we're going to stay with this 1396. I think that's going to be important in 1403 on a daily. And yes, we are in a range. And in the cable, we had, I think it was 2720. Yeah, 2720. Obviously, we had some impact with this whole concern with what happened, in the U.S. session when it opened up. We'll just go right there, 2704, and that's going to work like a trigger if we get beyond that. I have no real take on this cable. I think it's just tough as rocks to trade, unless you're looking at very, very short term. So like this was good right here, and the market came back, but I think it's just a very tough market to trade. Very tough. Right here, 2793. Just put it right there, 2793. At least we're tightening it up. Moving on to the Aussie dollar. Well, we were looking for a move to 72.50 earlier in the week, and the reason we're looking for that, you can see that right there. The 38% came in right there. But we've pushed even lower with this whole Chinese concern. So it's going to be right here, 71.86. And boy, they've really pushed this thing down. So it'll be 71.86. That will be resistance right there. 72.77. I think that this whole thing that happened and this big old flash crash, and it's nothing short of a flash crash. I mean, this is just, you fall like that. And then the CME said it could have been a lot worse. They actually stopped the trading in, over an area of seconds to slow it down. So yeah, it was a flash crash. You don't lose that much. Like me and Joe talked about, you don't lose that kind of without being further pressure. Certainly they did go in and test that. Let's take a look at the Kiwi. Boy, we've really come off now. We were looking for 68.61. It looks like we may have got it. The low was 68.56, and we had the support. Remember, we were looking for a pull back down now because we said we'd come so far so fast. I mean, we'd come a long ways and nary even a pullback. We had a resistance at 69.39. Yeah, right there. We're seeing any pullbacks up in here. Resistance now is going to be right there, 69.09. But I think we'll still have some more work to do. We had 68.61. It came down to 68.56. Look, this bottom of this zone is going to work like a magnet, and in all likelihood they would shoot beyond that. So I'd put it for right now 68, which isn't that far off. 68.34. Let's call it 68.34 before you see a bit of a reprieve, some short covering. So we're looking at 68.34. Now let's go to the dollar CAD. Now, that Bank of Canada was interpreted as being rather dovish. I don't know, being, it was going to be so dovish, but I'm not sure why people would have thought there would have been anything less. I mean, maybe not less dovish, but I'm saying to me, it didn't make any sense. Why would the Bank of Canada box themselves into, because with all the uncertainty we've had with China, it didn't make any sense. But that being said, when you look at it from a technical perspective, and I was saying myself, I like that 33.80. But I tell you what, as I said earlier in the show, you learn the most from your mistakes. And I've made so many mistakes by trying to fade runs. And hopefully I've started to learn my lesson. And that's one of the things I pointed out several times and even discussed with one of the guys in the Asian session yesterday. And I mentioned this even in the latter part of the session, US session. Look, there's the daily close there right here. Let's get rid of this. Okay. So you go by the daily close, and the daily close is going to be just like a 15-minute is more important than a 5-minute, and a 6-hourly is more important than a 30-minute, and a daily chart is going to be, a daily close is going to be more important than a 2-hour or a 4-hour. Okay. So what was the highest this market had gotten to? Right there. That's the highest it gone on a closing basis. You know me, it's all about the bodies. I call the touches. Right there, 33.43. So we were trading, I think, at around 33.80 or something like that. And I said, hey, look, as long as this market can defend 33.43 on the close, you have no choice. So the market's going to go with the momentum. They go to the next target. Now, the next target happened to be right here. It was 34. Right there, I think comes up like the body touch right there, 34.08, okay? But 34.12 happens to be the 71% of this entire move, okay? Now, the market was holding up at that 34.80. I think I even saw it even dip down to 33.59 or something, but it started to work up a little bit higher. But this whole flash crash thing made the concerns about the global growth, and something like that doesn't happen overnight. It's because that's been playing out for quite a while over the last few months, this whole China thing. But now with bonds rallying, you got this whole concern about growth. Then the crude oil, which was doing okay, and supposedly we were supposed to have that cut. Well, crude oil fell on that whole global growth concern there when the S&P's, crapped the bed. Okay, so that obviously opened the door for the dollar CAD to move higher. So one of the things is I saw it earlier this morning around 40-ish or so. I thought, that may not be a bad area. I'm not going to mess around with it right now. But as I was mentioning to one of the guys, is look, instead of just adding, and I've learned the most from that is, why don't you just wait till it starts to run out of gas? And what I mentioned earlier, late in the U.S. session, I was saying, hey, when the market can't go up anymore, then you can write it down. Well, in this case, wait for some momentum to change or for it to lose momentum upside, because you can't fight the upside momentum. That's why the market, it didn't mean that it was going to, because it was holding around the 33.80ish. It's actually started to work a little bit lower, at 33.60 and change, but the door's open for them to go higher. Well, all it needed was you got that little flash crash, the global growth, which knocked it's almost like a domino, which then with the bonds confirmed that's already been leading that, and we've heard the China concerns. We get the S&Ps hit that flash crash, and obviously the global concern and crude oil, then, which was already weak to start with, takes a header, and that pushed the dollar CAD up. Hence, that's where we are now. So when we look at resistance here in the dollar CAD, let's take a look here. Now we're 34.17, so not bad. We're starting to back off a little bit. We had been up as high as 34.44. But maybe we might see something today. It'll be interesting. It's going to be key if we can get a close below 34. It's actually going to be right there, 34.08. We need 2 consecutive daily closes below 34.08. If you get that, then you can say now the market may be starting to lose its momentum, and then you can see it's going to be a lot easier to take it that way when then the market wants to come down and test, then be stuck into positions holding. I've been there, and then I come in too soon, and then ultimately I may be right, but I had to ride the position for so long. I just say, you know what, I'm just willing to get out. Then everybody that jumps in gets to ride the train and make some good loot, and I'm there with a minor gain because I got tired of holding it because I came in too early. So it's a lot better to wait till the momentum starts to change. And obviously with the daily close above 33.43, certainly the momentum was going to push for higher. So the next key resistance here is right there on a very short-term basis, which is going to be 34.53. I don't want to spend too much time on it, but I thought it was important to point that out. Hopefully some people can benefit for the mistakes I've made in the past. And support for right now on a short-term basis is going to be 33.86. In case you're taking some intraday short positions. Let's go to the dollar Swissy. Resistance is going to be right there. It's pretty clear. We'll call it 99.89 right there. There was that little close right there, and we turn around and slip back down again. Remember, we had this, I pointed this out in the chat room. I don't know if it was yesterday or before yesterday, right here. So this market is more apt to, on the rallies, to easily pare back a little bit. Not a market I care much to trade at all. But it's going to be 99.89 with support. Really, it's open to go lower. Support's going to be right there, 99. Call it 99.40. Okay, let's get going here. I had 1325. I posted and then I was working on a limit 1324 and it getting filled. So that was frustrating because it's the second time in 10 days I've top ticked this doggone dollar yen and missed it. And I had every chance in the world to sell it. And I was going to sell it at 21 and 22. I said, no, I'll just stay with my 24, and I didn't get filled. So the resistance for right now is going to be right there, 1319. We'll just call it 1320. And I'm just trying to hurry up real quick because we spent a lot of extra time and now we're running behind. Man, that's a good area right there. You see that 1262? This will probably end up working as a trigger. We'll just keep that 1262 for right now. But you see the touches right there? Right there. So 1262, I went right there to that. So it's going to be 12. 62. We had 66. So that wasn't bad there. Considering we were at 1420 yesterday. Let's hurry up and move into the cash dollar index. Well, it's been all about this 97.14 and this 97.19 or 18. You can see right there. So we'll go with 97.18. Support on the downside. We'll go right there, 96.81. Not expecting to lose very much at all. As far as gold, no changes here. Boy, we're starting to clip along now. 1248 is going to be the same thing here. No changes here in the gold. Got to get past 48. Haven't done it so far, but the door's open for them to move higher. And they're holding up very, very well here. No change. Support's going to be 37. So no change here in the gold. Boy, we're starting to catch up pretty good. On the bonds, for right now, 42.26 right there. We're pretty close to it, but that's going to be resistance, 42.26. This thing is really taking off like nobody's business. Support. We can start to slide, so we're going to put it right there. I usually don't go with the tail, but I think it's important in this case. So we'll go with 41.31 on a short-term basis. You have to start paying attention to the bond market going forward, because obviously if we see a pullback, that'll certainly help the dollar. If we see a more exaggerated pullback after NFP, but I'm not so sure that a pullback would even help. Pullback would just provide a buying opportunity in my eyes. Let's take a look at the buns. Look at this. Wow. Just still pushing higher. That global growth story has got some teeth in it, folks. Support is going to be right there, 61.91. That's a long ways off. So we actually have to put it in and fill that gap, which is 62.05. Good luck trying to stand in the way of something like that. People say these moves are hysterical, like it said in that story. Well, you can say hysterical all the way up, but you're going to be saying hysterical and losing your shorts. Oh, this is hysterical. It's hysterical. It's hysterical. Yeah, it keeps on going higher. And resistance. For right now, it's 62.51. And let's go into the DAX. Wow. I mean, what can you say? I mean, whew, doggone thing got clobbered. It certainly looks like it's going there. The real support comes in at 10.781, and that's a long ways off, but it's got to go with that. That's where the real support is. Let's call it right there. 10.7. We'll call it 10.788. It may not get there. That's still a ways off. a little ways off, but you want to be caught with your pants down. Resistance. We'll just look at today's range. $10,984 right there, $10,984. Okay, and that concludes it for the bias chart. And I'll get this posted in the room. And thanks for joining us here on the European crossover.